From New York City, for our viewers worldwide, I'm Taylor Riggs in for Jonathan Farrow. Bloomberg Real Yield starts right now. Coming up, Treasury's fluctuating after further signs of economic resilience, fueling a rebound in U.S. junk bonds ahead of the holidays, all as traders debate Omicron's potential impact on monetary policy. But first, we begin with the big issue. How hawkish is a hawkish Fed?
We're looking at a more hawkish Fed.
We're at peak Fed hawkishness.
It's all about what the Fed is going to do.
Year-end liquidity is pretty terrible.
Virus fears and short-term economic concerns are perking up.
The bigger question is, what regime are we going into next year?
People are now paying attention to the prospect of monetary tightening.
The Fed is going to be more aggressive.
The question is will the Fed be hiking?
The Fed may struggle to implement all three hikes.
Will real rates move higher?
I don't think the Fed's going to put in as many Fed rate hikes, because I don't think they're going to want to get anywhere near an inverted yield curve.
My concern is that it's not going to be up to the Fed.
What is the Fed's reaction function?
If inflation super overheats, it's going to force the Fed's hand.
Joining us now, Academy's Peter Tchir, James Camp of Eagle Asset Management, and our very own Bloomberg's Molly Smith. Peter, let me start with you. It's this push-pull in the market. I think that's the big debate. Inflation versus the variant versus the slowing economy. How are you thinking about a hawkish Fed and peak hawkishness?
I think we are going to see a lot of inflation. I think we are going to see some growth next year. I think ESG and the pressure to build out on ESG is inflationary. So we're going to see all that. At the same time, I think the Fed is not going to be as hawkish as they tried to signal on December. They had a very political motivation. They're trying to keep Washington happy. I think they're going to be very, very slow to hike, and they are going to let this economy run very hot next year.
Interesting. James, do you agree? Because the market's looking at anywhere from 3 to 4 hikes next year.
Well, I think the mindset of the market now is decidedly reflationary. This is something we believed, 12 months ago. And this is a complete regime change for the Fed. I don't think the markets can look to the Fed put. I think the Fed is going to have to respond to the inflation pressures that are building. And as Peter just mentioned, this is a political thing now. The man and woman on the street, they see price levels high. Rate of change in inflation may slow, but this is a regressive tax on many, many Americans, and it's curtailing a lot of the fiscal agenda. So I think the Fed is front and center. I see 3 hikes in 2022.
Very interesting. Molly, I am curious. So we've had the political conversation come into this. Do you hear that as well from some of the sources that you're speaking to, and a tax that is inflation on the consumer?
I think if anything, that's what makes some people more inclined to say that there's a possibility for 2 hikes next year instead of 3, especially now as Omicron is becoming much more embedded in the economy and really dampening the sentiment outlook. Interestingly, we saw consumer confidence today that was higher in December, which was really surprising, but it seems that still the inflation outlook for consumers is still very high in the near term, not so much in the long term. So still remains to be seen if next year, if we're, where the Fed is at, if it is that 3 hikes plus or minus.
So, Peter, interesting. I want you to read this note with me. It's from UBS's Paul Donovan, expecting that, well, maybe not so much inflation, but the variant, the Omicron variant, it's going to have a lasting impact, but it might be limited. He said, quote, "I would regard Omicron as a short-term disruption rather than something that changes the economic narrative of 2022. People are adapting, and that lessens the economic impact." So, are you seeing a lower than expected economic impact with this variant, and that's the call that inflation is running hotter?
Yeah, I'm actually quite comfortable with what we're seeing in Omicron. Obviously, the caseload is very high, but when you look elsewhere, one, the caseload diminished fairly quickly, and then more importantly, you're not really seeing the hospitalizations, right? So if you have this hospitalization usage battle, I don't think you're going to see that here. I think we're going to get through this. This is going to be very mild, and that's actually going to be a really big boon to the economy. I think people will be able to get over coronavirus and COVID for a little bit and move on. My big concern still in the economy is how much of consumer spending was front-loaded because of supply chain issues. So I think consumers actually overbought early this year ahead of the supply chain issues. So I think we might see a bit of an inventory, a slowdown in that first quarter. And then we move on really as we see some federal stimulus, we get this, ESG build out and supply chain repatriation.
Interesting. James, I mean, I have to laugh. I really thought 2 years ago we wouldn't be health experts, and here we are. It's the end of 2020, and we are still talking about COVID. So I will leave that for what it is. But James, on that note, talk to what Peter was saying about of sort of this headwind. Is that transitory? Is the Fed doing the right thing by sort of looking through that and any supply chain and then economic disruptions that it might cause?
Yeah, maybe the analog back to September is Taylor is important because we had the spike and we had a little bit of a scare and we had risk markets sort of sell off. This feels a little bit like that. I too, armchair epidemiologist as we all are, we're looking at Omicron hopefully. As we know, the United States is behind the industrial world in vaccinations. If this proves to be a more transmissible, less virulent version of the virus, that may actually end up being a good thing. Look, supply chain isn't changing anytime soon. We still have at least a 10-month lead time in terms of unraveling supply chain by our data. But we have juxtaposed difficult supply chain issues with this massive demand. And Peter mentioned, is it pull forward? Is it permanent? We can simply not meet the consumer demand, which is absolutely off the chart right now. And we got to remember the amount of fiscal and monetary stimulus, the looseness of financial conditions, it is extraordinary. And to me, if inflation didn't show up this year, we'd have a real problem because we would have no natural governor to, wanton government spending, MMT, and all the other things that are to me long-term net negatives for the economy. So inflation rearing its head, to me, is a net positive for the real economy and for policy going forward.
Peter, just weigh in quickly on this because there's been a big debate. I get screamed at every time I mention it of if tapering faster, is it tightening or just less easing? Because we've talked a lot about all the liquidity out there. How are you looking at a faster taper?
I view it as less easing. Personally, I think we should have started tapering much sooner. So maybe that's the policy mistake and not so much on rate hikes. But so when I look at going forward, my view is we are going to see inflation. We're going to see build outs. We're going to see supply chain repatriation. We're going to see more factories announced here. So I think you really want to look to cyclicals, areas that benefit, and then the areas that have benefited from the TINA or the FOMO, right? The people that the asset classes or subsectors that really benefited from this money sloshing around. I think you could see a little bit of a pullback there. So I think next year in stock market's going to start a little bit like this past year where it's rotations and the overall market's going to do one thing, but really capturing those inner rotations is going to be key. And so I'm looking at a pullback of all those stocks and sectors that really over benefited from QE and look for much more of the value and quality stocks to open next year.
Very interesting. Molly, I want to come to you. It's interesting. We got another note from Deutsche Bank's George Saravelos saying that persistent economic risks say, quote, the supply side, it's anything but gangbusters. It's more reminiscent of a secular stagnation paradigm instead. This in turn prevents the market from aggressively repricing terminal rates. Either supply recovers, pushing inflation back down, or if it doesn't, it means that there is something seriously wrong with the economy's potential. Looking back at this year, Molly, the word stagflation started to creep in a little bit. People say it's a dirty word. They don't want to talk about it. But that was something that at least we've started to hear some murmurs about. What are you hearing?
It's definitely hard to argue that when growth is still as strong as it is and projected to be for the fourth quarter as well. And we'll hopefully get some better light on that tomorrow as well when we get the personal income and spending figures. So that's, kind of what we were talking about before, of like the pulling forward of shopping this year and so much of it in anticipation of the supply chain issues. That was definitely evident in the fourth quarter with the holiday shopping season. So when we saw retail sales not come in as strong as expected, definitely supported that thesis. But tomorrow, when we get the inflation adjusted spending numbers, could really shed some light on just how much inflation is affecting consumer spending right now, therefore growth, and hopefully we'll get some better light on like what that means therefore for going forward into next year.
James, wrapping all of this together, I think if I told you that at the end of this year we'd be at a 146 on the 10-year, you might have thought I was crazy. Is that a fundamental story, or are there a lot of technicals playing into this?
Yeah, I think in the Treasury market, it's very much a technical story. I mean, you still have the largest, most price indiscriminate buyer out there in the Federal Reserve. They are going to begin sunsetting those asset purchases. Real rates are still largely negative, and we've had these fits and starts with the COVID pandemic moving in and out. I think that's what's keeping a lid on the term structure and the term premium. I think as the Fed begin to normalize, whether it be 2 or 3 hikes, you're going to see some pressure on the long end of the Treasury curve. As Peter mentioned, and I fully agree, some of these companies with great earnings, great margins, great free cash flow that are pushing through higher and higher dividend yields to their clients, to their owners. The ownership side of the balance sheet to us still looks a lot more attractive than the lending side. And until the 10-year gets to a 2.25, I think it'll probably stay overweight the dividend income side in our multi-asset class type strategies.
Peter, is that a technical more so than a fundamental story? It's incredible of a 146, and then as James just mentioned, a real yield that's still negative 1%?
I think it's a mix, right? I think there's been a lot of technicals going on. That's one reason you see the 20 to 30-year part of the yield curve kinked. There are a lot of people who are forced buyers of long-dated treasuries, and so that 30-year trades better than the 20-year, which would be unusual if there weren't some kind of funky things going on within the market. And then a little bit, it's fundamentals. You really saw this flattening as people started pricing in rate hikes. So the market, in my opinion, believes that the Fed is going to hike, and that's going to be a policy mistake. I think the market's going to be surprised that the Fed doesn't make that mistake. And I want to shift back quickly to your question about stagnation a few minutes ago.
Yes.
I completely disagree. I think we are in a paradigm shift, and China was one of the biggest deflationary pressures over the past 10 years. And what I think we're going to witness is Beijing Olympics, the Summer Olympics was China's coming out party to join the world. The Winter Olympics is them going back to re-centralize, focus on their own business. That is going to be an ongoing inflationary issue. We are going to see more and more products built and manufactured in the U.S. You're seeing tech battery plants, semiconductor plants, all announced in the U.S. So I think we are actually going to see high inflation, and it's going to be a sign of repatriation of our economy, how we build, who we do business with. So it's going to be with our closer allies, both in terms of proximity and, philosophical ideas.
Yeah.
So I disagree that high inflation is going to be a sign of stagnation. It's going to be a sign of a different economy, and that's what gets me excited about growth for next year.
Okay, interesting. So to follow up on that then, Peter, what do you think about U.S. versus rest of the world? Within the equity markets, that's been the clear winner this year. Within a world of credit and bonds, is it then continues to be U.S. versus everyone else?
I think in our bond market, we're going to continue to do okay. I think we see higher yields as people realize the Fed's not going to be as aggressive. So that's going to push the long end of the yield curve up a little bit. I actually like foreign stocks, and I'm even trying to, it's really hard to pull the trigger on EM here, but I do think foreign stocks, particularly European, Canadian, if I had one place that I really want to put my money right now, I would say Mexico. I think Mexico is going to be a massive beneficiary of this shift in production that I see coming.
James, U.S. versus rest of the world?
For yield investors, interestingly, we are looking more and more towards Europe and developed countries outside of the U.S. because of lower valuations, more attractive valuations, and higher nominal yields. So as we look to the income space, some exposure to international equity-paying dividend stocks makes a lot of sense for us.
Peter Tchir, James Camp, Molly Smith, everyone going to be sticking with us because coming up next, it is the auction block. Long-dated treasuries back in demand. You have corporate issuers awaiting the new year. That conversation is next. This is Bloomberg. This is Bloomberg Real Yield. One of these days, I'm going to rename it the negative real yield, but I think Jonathan Farrow would not be happy with me. So we'll get back to that in a minute. Let's first get to the auction block. We want to kick things off here in the United States. Of course, high-grade bond issuance coming to a halt ahead of the holidays, but not before pricing a December record $61 billion in the first 2 weeks of the month. Junk bond issuance remaining closed as well, pricing nearly about $9 billion this month, marking it, though, one of the slowest Decembers in 3 years. And finally, strong demand for the Treasury's auction of 20-year bonds this week, with direct bidders taking down a record portion. Peter Tchir, James Camp, Molly Smith still with us, of course, joining us maybe around the table in person one of these days. In the meantime, Peter, talk to me, because you were mentioning, we left the last segment talking about not having this stagflationary environment, really seeing some optimism in terms of growth and maybe some of this inflation as well. What does that mean then for credit spreads? If it's 100 basis points in investment grade over treasuries, only 300 in high yield over treasuries, is that appropriately risk adjusted returns?
Yes, I think we're going to actually see slightly tighter credit spreads. I think high yield and leverage loans can do well. It's not going to be a home run sort of year, right? You just can't tighten that far from where you are. But I think people keep looking at it saying, wow, this is kind of tight. If you go back to, pre-2000s, they were much tighter than this. I think credit, unfortunately, for a lot of people is going to be a relatively boring market. You're going to earn your little bit of spread. So you're going to have to dig deeper into high yield. You're going to dig deeper into leverage loans. You're probably going to have to stretch a little bit and do some structured products. But as a whole, I'm very comfortable with credit. And I think it's going to be an okay performer next year. If you want to generate a lot of alpha, it's probably not going to be in credit, but you're not going to get hurt there, especially if you move down the credit spectrum and look for odds and ends that aren't picked over already.
James, do you agree?
Yeah, we sort of look at income generation more agnostically. And I do think that credit spreads are fairly valued. I do think the double B space, triple B, kind of the crossover shorter duration area will do fine. But if we think about this massive issuance of corporate credit and we look at use of proceeds and what corporate capital structures are really doing in terms of rewarding shareholders with growing dividends, which some of these are compounding at double-digit rates, if the individual investor is not style boxed into a pure debt or pure equity portfolio, being flexible around that is really going to allow them to continue to generate and compound growing income. I would step aside from bonds generally as a slight underweight, just given the term structure and what we think will happen. But credit spreads and credit quality by and large across the board is in exceptionally good shape. So we don't have a concern of default risk. We don't have a concern of massive spread widening, but we think there's better relative value and income elsewhere in the capital structure.
Molly, are you hearing that as well, of little FOMO type attitude with having to take on some of the extra yield and extra spread given how tight spreads currently are?
Yeah, I think given what's been said, it is, like Peter said, a little hard to get excited about credit right now, that it is all just like really priced to reflect everything that's going on. And there aren't a whole lot of catalysts that could change really where spreads are at right now. I think, the supply picture is still incredibly strong, but given where the proceeds are going and how that's strengthening the shareholder side of the equation, I almost wonder if it's just easier to get more excited about the equity side of the balance sheet in this kind of environment.
Peter, she's hitting on something that I wanted to ask you as well, so this is a good segue. The role of a bond in a portfolio, particularly junk or high yield, is it equity light or is it a diversifier? I mean, what is the role then? How are you thinking about that next year?
So when I look at it, I think of investment grade as kind of a replacement for Treasury yield. So that's a bit of a yield play. You've got to be a little bit comfortable the economy is going to do well to prefer investment grade bonds over Treasury. So I'm there with that. I think on high yield, it's a little bit of a substitute for equities. And I agree right now. I would probably, what James had just said, is I'd probably be a little bit overweight dividend stocks. I like some of the sectors like cable, communications that are paying decent dividends. The stocks haven't rallied that much. So that might be a more interesting place than high yield or leverage loans or structured products. But depending on what you're forced to do, that's why I'm a little bit more comfortable with the high yield leverage loan area. But to me, that is much more of a equity type replacement than investment grade.
Interesting. James, are high yield bonds at these spreads acting equity like?
Yeah, generally speaking, there's going to be a higher correlation in the high yield market to the equity market. What is interesting about 2021 is the one market that we haven't spoken about, the tax-free market, is actually decoupled almost completely from the taxable market. So as a non-correlated sort of anchor, especially for the non-qualified investment, meaning money's outside of the IRA 401k arena, they have been a terrific asset class, not only from a performance standpoint, but from a diversification and non-correlation standpoint to some of the equity risk budget that clients may have. So I think that's probably a better deployment of fixed assets as a diversifier than the taxable or high yield market.
James, when you say tax-free, all I think is munis, and that's not okay to do when we have to go that segment. So we'll come back and I won't go on a muni rant. Everyone going to be sticking with us. One more segment still ahead, and it is the final spread the week ahead, featuring, well, some big global PMIs, another short holiday trading week in the bond market. That conversation is next. This is Bloomberg. I'm Taylor Riggs, and this is Bloomberg Real Yield. Time now for the final spread to take a look at what's coming up. We have to get to Christmas first, but then, of course, yes, there will be some economic data on deck with the new home sales, durable goods, and another round of jobless claims. That's coming up tomorrow. Then, of course, we do have those U.S. markets that are going to be closed for the holiday on Friday. And then wholesale inventories and pending home sales will be coming next Wednesday, followed by China PMIs on Thursday. Finally, yes, indeed, bond markets closing early on Friday because of New Year's Eve. Happy just to get through this year, I think we could all say. Peter Tchir, Molly Smith, James Camp, of course, still with me. This year, arguably, maybe there were a few curveballs and some few surprises. Peter, let me start with you. As you think to next year, what's the biggest risk that you see on the horizon?
That we underestimate how much we're going to have to spend to build out ESG and sustainability, that we overestimate how quickly China wants to get their supply chains back to us. So I think we risk understating how bad inflation could be, and that is my fear.
James, what do you see as the biggest risk, particularly as well for the bond markets into next year?
I always watch when we have periods of massive accommodation and really loose financial conditions. I watch deleveraging, and if and when the Fed moves short rates and funding costs go up, you know, what sort of accidents show up in terms of the carry of the levered players. Inevitably, they will. I think we have some suspicions about where they might be. We're seeing some of that in the NASDAQ performance of late, but I do think return to value and return to selection of securities will be the story of 2022.
Molly, from everyone you've spoken with, what is the biggest risk on the horizon for equity bond markets, I should say?
I think the risk is that, just as we're in this global tightening cycle right now of central banks, is that what if it fails to counteract inflation? And the reason being is because when you are tightening policy and raising interest rates, that's not really meant to address a supply side shock, right? You know, you could in fact create a negative demand shock, which is not going to solve the problem that we're in. It's not going to restore global supply chains, and inevitably that's not really going to help the inflation picture either. So I think that ultimately is a risk that I'm looking for.
One rapid question here, Peter, where do you see the 10-year yield the end of next year?
Yeah, let's call it 175. I'd like to say 2%, but that's been such a bad call. I'll stick with 175.
James?
I will concede that as well. 175 is pretty big resistance, but I do think we have a low 2 handle at the end of next year.
Molly, I'm going to spare you. To think that we're still at a 147, we didn't even get to 2% at the end of this year. Pretty incredible. My thank you to both Peter Tchir, James Camp, Molly Smith. From New York, that does it from us. This was Bloomberg Real Yield. You've been watching Bloomberg.